is the interest on digital payments, whereby you're saying that this is the way to go. But then we're also looking at a number of other things. For example, if a leasing company pays 10 million shillings in interest, but earns 20 million shillings profit, only part of that interest can be deducted under the current rule. Under the new proposal, they can deduct the full 10 million. Companies can only deduct interest costs up to 30% of their profits. The proposal under the finance bill says it seeks to change rules on interest for lending and leasing businesses. The proposal says these businesses will not be limited by the 30% rule on interest. This is one of the changes that comes on. The bill seeks to tighten reporting rules for virtual asset service providers. There is a new proposal under the finance bill that seeks to introduce a 25% excise duty on new mobile phones. The proposal says smartphones and feature phones will attract a 25% tax on the point of first activation on a Kenyan mobile network. What do you think about that? Whereby, obviously, we're in the digital age, a lot more is being done now using digital assets like this. But to purchase one, you need to pay a little bit more money. Is that encouraging local manufacturing, like we were told yesterday is actually happening in Kenya? Or is it just saying that imports will be more expensive?
Oh, very well. I think before I go for that, I think I want to demystify a myth that has existed every year, that we must always have a financial bill.
Okay.
It is not always true. We should not. Actually, if I was the CS Treasury, I would not have.
Why?
Because what largely this bill has is more of reforms and compliance issues. I would just done amendments, just like what they did in 2025 for the financial bill that fell flat, financial bill 2024. So it's not always that you must have a finance bill. Yeah, I think James will concur with me. Number two, when I saw the proposal from CS Buddy last year about giving relief to those earning 50,000 and below, I see it is not possible because there was no trade-off. There was no trade-off.
What does that mean?
It means that if you lose 50 billion, you must show me where you are going to get it because you need the money. So it is not possible, and it won't even happen this year because the government looking for revenue that is not coming through. Back to, then I'll go to another thing. Back to what you're saying, the most significant also proposal is about 6% assumption on capital gain or profit, where the government is assuming that 6%, they want to take off 6% from the company's profitability, assuming that is a distributable profit, like a dividend, meaning that even before you go, when you do your returns, I think that is true, James, you knock off 6%. The company, corporates pay 6% to the government.
Okay, I'm sorry. So I have a donut company. I'm making good money in 2025. On profit, I've made, I don't know how many donuts we're eating, but okay, let's say I made 100 million shillings from donuts profit. I am supposed to give 6% of that profit to government.
It's assumed that is a distributable profit, it's dividends.
Okay. To shareholders and such.
To shareholders. So you need to pay that to the government.
Okay.
So what it has, for me, I know James is looking from the taxation regime. My eyes always look from the economic perspective. What does it mean for economy? And especially so when you're looking for investors to come and invest in the country. It means now investing in the country becomes quite expensive. And if I had my money, why would I come to Kenya? Why should I not go to Tanzania? Why should I go to Rwanda? So I think I keep saying that Treasury, CS, should always have what we call theory of change every time they are doing the finance bill. For example, when you talk about 25% excise duty on mobile phone, mobile phone nowadays is not just for saying hello and goodbye.
No, it's not.
It's an office, meaning now that it becomes expensive, it becomes unaffordable, and you're talking about digital economy. You're talking about creative. You're talking about youth who will otherwise want to buy a good phone so that they're able to go to the digital economy and make some money. What does that mean for that young man in Mhaya in Western Kenya? And you're telling him for him to buy a good phone, he need to add about almost an extra 10,000. And maybe that is how much he had. Also, what you talk about the transfer, money transfer, you're looking at financial deepening and inclusivity, and for transaction to be affordable. The economy is built on production and consumption. Meaning, if consumption is affordable, the government will be able to correct more of VAT, what we call the consumption taxes. But when you make, in one hand, you make one phase of it expensive, then means the economy does not grow. For me, where I was talking about the theory of change, if you look at also the proposal about the digital space, whereby there's exemption of VAT on some of even the networking. And the government is saying it wants to make about 100,000 of fiber cable across the country. The government itself becomes very expensive for it to lay. You know? It becomes very expensive for them to lay the cable so that it can achieve what it has promised on the manifesto. Then there's another proposal, 5% on Mituba.
Yes.
Meaning, before you get your container from Mombasa, it's like an advance tax, what Matatus pay. So meaning, whether you make profit or not, you must pay 5% on Mutuba. And then, it means now, those more informal traders who trade largely on such, becomes the same will going to be passed over to the consumer. The same with the rental income.
So all of this essentially goes to the end user. That's what we're talking about. So when we see it as, it could be a punitive tax or it could be a restorative tax, whatever the case may be, but that there is an increase in how much somebody is going to spend. And more often than not, that goes to the end user.